Unlock the power of Forex trading through the lens of technical analysis, where we'll decode the secrets hidden within price charts, patterns, and indicators to help you make more informed and profitable trading decisions. Welcome to this comprehensive guide on the basics of Forex technical analysis. In this video, we'll demystify the world of technical analysis, breaking down essential concepts and tools that can help you analyze and interpret price charts effectively in the Forex market. Whether you're a beginner looking to get started or an experienced trader seeking to enhance your technical analysis skills, this video will provide you with the knowledge you need to navigate the Forex landscape with confidence. Please don't forget to like, share, and subscribe for more informative content on Forex trading and other financial topics. So, let's jump right in. Understanding technical analysis. Technical analysis is a powerful tool that allows traders to dissect financial markets by delving into historical price data, deciphering patterns, identifying trends, and foreseeing potential future price movements. It operates on a fundamental principle that the past can offer profound insights into the future direction of prices, and it's grounded in several key principles that form the bedrock of this analytical approach. Key principles. Before we dive into the tools and techniques of technical analysis, let's explore some key principles. Price discounts everything. This foundational principle underpins technical analysis, suggesting that all available information, be it economic data, news events, market sentiment, or geopolitical factors, is already factored into the price of a currency pair. In essence, this implies that rather than dissecting a multitude of external factors, technical analysts concentrate primarily on the price action itself, focusing on chart patterns, trends, and key levels. Price moves and trends. Another pivotal belief within technical analysis is that currency prices generally move in trends. These trends can manifest in various forms, such as bullish, upward, bearish, downward, or range-bound, sideways. The heart of technical analysis revolves around identifying these trends, as they provide traders with valuable insights into potential future price directions. History tends to repeat. Building on the psychological and behavioral patterns observed in financial markets, technical analysts hold the conviction that historical price patterns and market behaviors are inclined to repeat themselves. This cyclical nature forms the basis for many technical analysis strategies, as traders seek to identify recurring patterns and behaviors that have historically led to specific outcomes. By adhering to these fundamental principles, technical analysts endeavor to decipher the language of the market, reading its historical narrative to make informed trading decisions. In essence, they strive to uncover the hidden patterns and signals embedded within price charts, thereby gaining an edge in predicting potential future price movements. Key concepts. Candlestick charts. One of the fundamental tools in technical analysis is the candlestick chart. Candlesticks provide visual representations of price movements over a specified period. Each candlestick has a body and wicks, and the color of the body indicates whether the closing price was higher, usually green or white, or lower, usually red or black, than the opening price. Candlestick patterns, such as doji, hammer, and engulfing patterns, can signal potential reversals or continuations in price trends. Support and resistance. Support and resistance levels are crucial concepts in technical analysis. Support. This is a price level at which a currency pair tends to find buying interest, preventing it from falling further. It's like a floor that supports the price. Resistance. This is a price level at which a currency pair tends to face selling pressure, preventing it from rising further. It's like a ceiling that caps the price. Traders use support and resistance levels to set entry and exit points and to manage risk. Breakouts above resistance or below support can signal significant price movements. Moving averages. Moving averages are popular technical indicators used to smooth out price data and identify trends. Simple moving average. The SMA calculates the average price over a specified number of periods. It's a lagging indicator that helps identify the overall trend direction. Exponential moving average. The EMA gives more weight to recent prices, making it more responsive to recent market developments. Traders use moving averages to identify trend reversals, potential entry points, and the overall direction of the trend. Relative Strength Index. The RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is often used to identify overbought or oversold conditions. A reading above 70 typically indicates overbought, suggesting a potential reversal, while a reading below 30 suggests oversold conditions and a potential upward reversal. Technical analysis strategies. In the vast realm of Forex trading, technical analysis strategies serve as invaluable guides for traders seeking to navigate the turbulent waters of currency markets. Let's delve deeper into some of the most prevalent and effective technical analysis strategies that traders deploy to gain a competitive edge. Trend following. This strategy revolves around capturing and capitalizing on existing price trends. Traders employing trend-following strategies diligently analyze moving averages and trend lines to ascertain the direction of the prevailing trend. By aligning their trades with the established trend direction, traders aim to ride the momentum and profit from sustained price movements in that direction. This approach allows traders to remain in sync with the market's prevailing sentiment and can be highly effective during prolonged trends. Breakout trading. Breakout strategies, on the other hand, target key support and resistance levels. Traders identify these pivotal levels on the price chart and pounce into action when prices breach them. Breakouts are often indicative of the potential for robust and swift price movements. Traders harness this volatility to initiate trades, with the expectation that prices will continue to move in the breakout direction. However, they remain vigilant for false breakouts, where prices initially move beyond support or resistance but quickly reverse. Discerning genuine breakouts from false ones is a skill honed through experience. Support and resistance. Among the most straightforward yet effective strategies in technical analysis is the utilization of support and resistance levels. Traders establish entry and exit points by buying near support levels, where buying interest tends to emerge and halt price declines, and selling near resistance levels, where selling pressure tends to materialize and impede further price increases. This strategy can provide a clear and structured approach to trading, bolstered by the historical significance of these levels in influencing price movements. Oscillators. Oscillators, exemplified by the Relative Strength Index, RSI, play a pivotal role in technical analysis. These indicators help traders identify overbought and oversold conditions in the market. When combined with other technical analysis tools, oscillators can yield valuable entry and exit signals. For instance, if the RSI indicates that a currency pair is overbought, typically when it surpasses the 70 mark, traders might consider this as a potential signal to exit long positions or even initiate short positions. Conversely, an oversold condition, often signaled by an RSI below 30, may indicate a potential opportunity for a reversal and a long entry. These are just a few examples of the myriad technical analysis strategies available to Forex traders. Successful traders often combine multiple strategies and tools, adapting their approach to the ever-changing dynamics of the Forex market. The ability to recognize when a particular strategy is most applicable and the flexibility to shift gears as market conditions evolve are skills that can set traders on the path to consistent profitability. Limitations of technical analysis. While technical analysis is a valuable tool, it's essential to be aware of its limitations. Not always predictive. Technical analysis is based on historical data, and past performance is not always indicative of future results. Price patterns can fail to repeat, leading to unexpected market moves. Subjective interpretation. Different analysts may interpret the same data differently, leading to variations in trading decisions. Limited in isolation. Technical analysis is most effective when used in conjunction with other forms of analysis, such as fundamental analysis. Conclusion. In conclusion, technical analysis is a powerful tool for analyzing and interpreting price movements in the Forex market. It provides traders with insights into trends, support and resistance levels, and potential entry and exit points. While technical analysis has its limitations, when used effectively, it can enhance a trader's ability to make informed decisions and navigate the complexities of currency trading. Thank you for watching this video on the basics of Forex technical analysis. Whether you're a novice or an experienced trader, understanding technical analysis can be a valuable asset in your trading journey. If you found this video helpful, please like, share, and subscribe for more informative content. Happy trading!